Welcome to the Tokenomics DAO podcast, where we explore everything tokenomics related, ranging from deep dives on the tokenomics of the newest protocol to demystifying the nuance of building a successful token ecosystem. Our goal is to bring awareness to the importance of tokenomics and the crucial role it plays in defining the success of a protocol, helping make tokenomics relevant for everyone, builders and investors alike. I'm your host, Flo, joined by my co-hosts, Jason and or Lovis. Welcome to the podcast.
Welcome to another episode of the Tokenomics DAO podcast. Today, Flo and I are going to talk about basics of tokenomics part 2. We did an intro to tokenomics episode a few months ago. It was one of our most listened to episodes. In the meantime, we have produced, or it's not quite complete yet, but almost there, an online course, which, as I just said, will launch here probably this week, full in its final version. It's already open for sign up, which also covers the basics of tokenomics. And it was produced doing live sessions on our Discord, and on average we had about 20 people attending each of these sessions. It was 5 sessions, and it went from first principles, like what is a cryptocurrency, all the way to the basics of modeling and simulation. And in the course of these live sessions, of course, we had lots of discussion and people asked lots of questions about tokenomics. And so I just went through and pulled 20 of those questions from the first couple of sessions. And Flo and I are going to go through and pick them up, pick them apart, discuss them a little bit, and give some background information to them. Just want to, we want to genuinely educate on the subject. A lot of these questions will not have like a super definitive answer, but maybe hopefully they'll just get us, philosophizing. And we'll kind of treat this like a conversation between him and I, where we hopefully share some insights.
Great.
Yeah, Flo, welcome. Thanks
go.
for doing this with me.
Thanks. Great audio with your new microphone.
I know. I just upgraded, so I'm also in the Rode camp now. We're not sponsored by them or anything, but maybe we should be.
If they want to sponsor us, I'm here. I can give you my address. Send me a few things. Don't even have to internationally ship stuff. I'm right here. Sydney,
right here.
Yeah.
So we start with the basics. We have a couple of different categories. They're not like in like a super logical sequence, but I think we're working our ways roughly from like less to more complex. So first question was if we can elaborate the difference between the tokenomics of a DAO and the tokenomics of tokens or coins in general, right? So this was asked by a person who said they're pretty new to tokenomics, and they were just kind of trying to think this through a little bit.
Yeah, that's interesting. What would that be, right? I think like DAOs are more like this community thing in most cases, or in a lot of cases. And then I at least haven't seen any sort of sophisticated mechanisms on how they integrate their token into some process, right? As with maybe other protocols or AMMs, lending protocols do it. Whenever you do something within that, you borrow something, or you lend something, or you do that, or you trade a lot, then you get tokens. That's kind of how a lot of these, like DApp tokens work. And for DAOs, but like all I've seen is like this membership that some of them do, friends with benefits, and a bunch of others, bankless DAO, where I always bring that example, but it's always like that. You buy some tokens, and then you can get in. You're part of the inner ranks, right? And that's kind of how the token works. And it's a bit pyramid scheme, right? Like the more people, like so you're early to the project, you buy in, and then you're kind of building it and doing whatever the DAO does, and then over time more people come in and they buy the token at like higher prices potentially from you. It's yeah. I mean, not exactly, because like the same would happen to a startup. You know, the founders or the early members, they would get a lot more share of ownership and shares in general than the later people, right? So the Facebook shares I might have bought, Mark Zuckerberg himself would have sold them perhaps. Right. And he got them really early and really cheap, and I bought them very expensive from him. But yeah, I think it's more like, yeah. But then there's also this, like, a lot of these like tokens and protocols that have more sophisticated mechanisms, they also have DAOs that govern them. So it's not an easy one. It's just, yeah, I guess it's very complex in what you can do with that.
Yeah. I mean, my answer there was, so first of all, I referred to the article that you had written a little over a year ago, where I think you had looked at the tokenomics of DAO, or like what is a DAO in general, kind of.
Oh yeah.
And I was like, well, so like if you compare like a layer one protocol, for example, to the tokenomics of a DAO, then in a layer one, it is much more set in stone, kind of. Like usually changing the rules is much harder, because there's probably, you know, the rules, the tokenomics are usually codified, right? They're put into the smart contracts or the code. So it'll take like a specific line of actions to change it, if at all. And in a DAO, probably it's a little easier, where it's more like a charter, like it's like, if you know, like an agreement, and then as soon as enough people agree to change it, then they'll just change it in a way. So
Well,
that was
I
kind of,
mean, Bitcoin could do the same, right? Like if they get enough people to agree to change, they could change the tokenomics of Bitcoin.
yeah. I guess it's just because it has grown into such a massive network, it just seems less likely maybe that happen.
I
But
think the more decentralized you are, the harder it gets.
yeah.
Yeah.
Yeah. No, but I
I
think
don't
it's
really know.
good.
There's probably not too many differences. I guess in general, they're all the same, right? They all have some supply. They all have some demand, hopefully coming from somewhere. I think like tokens and coins, I've seen more mechanisms in general than in DAOs.
Yeah, I tend to agree with that. I think that's also an opportunity for DAOs, right? To work out what are these processes to reward action, I guess.
Yeah. And we've done a whole podcast on that, right? Like
Yeah.
on how we're trying to figure out how to distribute our token that we don't have yet, that we might get, like how, based on what? Based on value creation. And we've been going through it for a couple of months, and it's not easy to figure that out, because yeah, it's really human. It's really tied to the humans and not to just some process or program.
Yeah.
So yeah, we might have some innovation coming there, but I haven't seen too much, to be honest, of it. Yeah.
Yeah. Well, I think that was a good enough answer. So moving on to number 2. How are tokens different from shares or equity shares? And then like follow-up question, I guess, was can a token, like, why can't a token have similar equity properties than a share?
I feel we should write an article about that. We've done.
Yeah.
Yeah, I guess there's a lot of aspects on that, and I'm trying to get to that the tweet thread as the summary. We should have like an overview of all the tweet threads that we've done, because sometimes I prefer going there because they're shorter than the articles.
Mm-hmm.
Like, I mean, of course, it's always good to read the article because you get the full picture, but the tweet thread sometimes gives you like this good summary, right? So I feel like there's, or at least in the article that I wrote, there's like 6 different things, or a couple of different things. There's like supply, they can have different supply dynamics, and often they are vastly different, like tokens and shares. There's this utility is also a lot different. Fundamentals look different. There's different ways of evaluating them, and then also governance looks very different. I can send it to you. I found it. if you want to share your screen. They, yeah, and kind of, how do I do that?
You can do it here in the chat or
Here it is. Sorry, just setting this up. So yeah, there's these different, like there's supply, utility, fundamentals, governance. There's different ways of evaluating them. All these different things between shares and tokens. And I think we even did like a whole podcast on that a while ago as well. So we can link that. But yeah, in general, if we start with supply, there's if you look at Amazon shares, they increase over time. So they're also like mildly inflationary, but that's like the first tweet up the top, right? But there is no Olympus DAO, or at least I haven't seen any Olympus DAO like shares. And what I mean with Olympus DAO is this, they had this hyperinflationary where they promised in the beginning, they had like a 30,000% yield on holding their token. And that meant they were minting a ton of new tokens all the time, right? So that typically doesn't happen with shares because it's just much more regulated. But with tokens, yeah, you can do whatever you want. And I think that's also pretty cool because people can try out that stuff. And while I don't really have the latest on Olympus DAO, but I'd love to see the history of their tokenomics because they've evolved a lot over time because they've seen like, okay, their initial approach of being hyperinflationary didn't quite work. So they've adjusted it and tweaked it. And that's what I really like about this whole token world. People can innovate a lot more because they're just allowed to try stuff. And if that at the end means they come out at the same result as equities and shares, yeah, it's also interesting. But yeah, I feel like like when I buy shares, I never look at the shares outstanding and how they've been growing over time. I don't know how about you, Lovis, but I never look at that when I buy shares. I mean, there's probably investors that do, but I feel like nobody really cares, right? Or pays a lot of attention.
Maybe when you're like investing in really small companies that are listed, maybe it becomes more of an issue. I've definitely come across that Jay had pointed it out to me about certain like probably like a gold mining company or something like that.
Yeah.
Who are I mean, they're using the capital markets as a way to increase capital, obviously, but for them it's like more relevant, I guess, than for like massive like $1 trillion companies.
Yeah, that's true. Yeah, but still, like I feel like everywhere in tokens you should look at that.
Yeah, with
like
with tokens you have to, right? Because that is like one of the key. That's like one of the easy pitfalls to fall into. If what the issuance rate is, and even the unlocks, right, is a little different. I think with equity shares, if there's like employees that have shares vesting, that wouldn't be a major concern for me. Whereas with tokens, I think that could be, because if it's a substantial amount that becomes unlocked all in one day and then that person starts selling, that could definitely impact your investment decision negatively, or so
yeah. Yeah, I think like with big corporations, the shares that, I mean, they would probably also like create new shares and use that as employee vesting, but they'll be really careful with that because the existing, I mean, with tokens the same, but the existing shareholders would be not very happy if they get diluted on their shares, right? So that, I mean, that means you're creating more tokens. So the was it the cake or the pie grows, but your slice stays the same size. It doesn't grow with it.
Yep.
Right. So yeah, I guess that's careful. And then on the utility side, just don't want to spend like the whole podcast on this, right? But like on the utility side, I guess they differ that there's for shares, they don't have a lot of utilities, right? You can to some degree participate in the shareholders annual meetings, and you might also be able to vote there. But yeah, with crypto, there can be a lot more. It can be used as a means of payment, perhaps, like with Chainlink. You could, you could use the the link token to pay for using their Oracle services or whatnot. There's like a lot of different things that can happen here. Where as shares, you probably don't really have to look at that, right? To look into that at all. And
means
yeah,
something
so
like probably, I mean, I guess one function that shares have is governance in a way, right? Because like there's
yeah,
shareholder meetings and stuff like that.
yeah, you can vote. Yeah,
But I think that's about it. I don't think that
yeah,
there's many other that they have in common with tokens.
yeah.
And then the asker was like, well, couldn't shares just be augmented to have more of these functions? And like, well, I guess theoretically they maybe could, but like it would require regulatory coordination to do that, and that's just seems very complex.
Yeah, and it's kind of all slowed down by that, right? So
Yeah.
there might be people who might be thinking it'd be so cool if we could do this with shares, or it could be so cool if we could do that with shares, but they can't because it's all regulated. And I mean, there's probably a reason for it being regulated, and that's good to some degree. But the cool thing in this whole token space is that people could just try out stuff, but of course the consumers or the investors aren't as protected, right?
Yeah.
Because you have to do the whole work of investigating this, right? What the utility does. So yeah. But like generally I feel that for shares, it's the same thing. Like people, if you evaluate shares, you only look at the business, right? You just look at that. So that's my, like, of this article, the core thesis is like, if you look at shares, if you invest in the traditional world, you just like spent like probably 99% of your time looking at what the business does and how that's going to improve. And with tokens, you should do that a lot more than you currently do. Like people who invest in tokens should look more at the business as well. But you also have to look at the mechanisms and the supply and demand dynamics of the thing, because yeah, there's so much more room for, yeah, I'm not gonna call it innovation, but like room for parameters to tweak
Yeah.
in this space, right? Yeah.
Yeah, and this segues perfectly into the next question. So this person said, well, there's many articles out there detailing how bad tokenomics can lead to poor outcomes for investors. But so asked me to like summarize again quickly, like why is it important to understand tokenomics, but also why is it important for projects to do tokenomics correctly? And if I had some examples of like where it was done bad, basically. And I mean, I think there's like an endless amount of examples where it's done poorly. And I think some of them are probably intentional, like they're scammy. They're trying to just extract money from people. But I think a lot of them are not intentional, and they just don't really know exactly what the rules they set in place, kind of which effect they're going to have once it's out there. And I think that's precisely why it's important to understand what tokenomics is, right? And if I had to give like the brief answer, it's always like incentive design, right? Like there's more to it, but at the core level, to me, it's always like what are we trying to get people to do, and how can we use tokens to get them to do it? And in that context, I think it becomes easier to think about it. What do you think?
Yeah, I definitely agree. It's what we kind of want them to do, but I think it's what is also important is it's not just about like what you can use your token to do. It's also why would somebody like go and buy that token, right? And how does that perhaps tie in with what your business does or with your project, what it does? You can't just hand out tokens. I mean, it's a great marketing tool, so you could like just give tokens to everyone. And I see a lot of projects that approach us like, yeah, we want to give tokens to these guys and to incentivize those guys and these guys and do this and do that. But then like my question always is like, so who's going to buy all these tokens? Because if nobody's going to buy them, then, well, the price is going to suffer from that a lot. Because there's no buyers, then the price is going to drop. and keep dropping.
Yeah.
So yeah, it's a bit of that, and a bit of that tying it to what the actual business does and how that can yeah.
Well, understand
yeah.
what the business does and how it creates value first, and then
Mhm.
evaluate if there's any mechanisms in place that would somehow connect that value creation to the token. And I mean, that is one aspect of tokenomics, right? Is that mechanism design.
Yeah.
Yeah.
Ideally, yeah.
And ideally, there's a balance. Somehow it can create a balance between supply and demand, which will have a stable price, right? That would already be fantastic. And then if the price keeps going up, will be even better.
yeah. That's what we want, right? So then you got the next one is kind of on the increase in supply. So that ties in, right?
Yeah. So it's a more basic question, I guess, but it's still relevant one that gets asked all the time. So how does an increase in supply affect price? Seems like a simple question.
Well, yeah, I mean, this is not even tokenomics. This is like really basic economics, right? If there's a lot of stuff being offered, if everybody has something to sell of the same good, then in order to find those buyers, the way you can is to reduce your price. Like, the products are all the same. Like if everybody has great red apples to sell, but there's only a few buyers, then the only way you can get rid of your apples is by reducing the price of the apples, right? So this is the same thing here. If there's a lot of supply of something and there's only few buyers, then the price goes down to find those buyers or to attract those few buyers, right? So the suppliers basically, they compete for the buyers, for the demand. And yeah, you can either do that by quality of your product, or by price here. So in this case, like, yeah, if you put up more tokens and the bid is absent, or the buyers are absent from that, then yeah, price will go down. So that's why I think it's like just really important to tie it to your business. So if you going to give out, let's say 10% of your tokens every year, right? So then you have 10 years to grow your business to that final size of tokens that you have in the space, right? You can do that, or your token price will just be quite low in the beginning. You could do that as well. I don't know how shares do it, right? If in an IPO, how many do they typically give to which parties? That's not often looked into, right? I guess it is, but
well, I mean,
I've got no
previous
idea,
equity
man.
holders in the business would then their equity, like from owning an LLC or whatever, I guess, would be then just converted to share ownership or something, wouldn't it?
Yeah, but then there's also a few shares that are just like openly sold on the market, right? They probably have an allocation. There's some cap table that they have to calculate all of that, and then, but they typically, they don't hold back on selling tokens or shares, right? They would just like bite the bullet and have a low share price in the beginning, wouldn't they? So you start with a very low share price, and then over time it grows.
Yeah, I guess so. I mean, I guess you come up with a valuation, like the business is valuated on whatever. And I think that's why you need I don't understand how IPOs work well enough, to be honest, but I think an investment bank is usually involved, and they evaluate the company and then give advice on like how many shares they should issue. And I think they also provide liquidity in the beginning to get the market, like, you know, on launch day, like somebody has to be kind of market making. And I think that's the company that's taking them, like that's the bank, I think, that's taking them public. But I'm not 100% sure how that works.
Yeah, I guess that's it. It kind of works similar in that regard. I think that there's someone providing that liquidity that make the market and trade it. But I feel like a lot of corporations, they're just happy with starting with a lower share price. Whereas in the token space, a lot of people are like going for these optics of starting at a certain token price. I mean, with shares, there's probably the same, right? With some corporations doing that. So I haven't really, maybe that's something that could be interesting to look into, right? Like who's trying to do what with their IPO versus at their token launch, right? I'm just looking at Amazon. So when they launched their token, their shares in 1997 at 0.09 cents, then, and then that's probably accounting for all sorts of share splits that they might have had, whatever.
Yeah.
Yeah, now like a single share is worth 119. And others, they've started at much higher prices per share, but that doesn't mean that the market cap is any higher, right? It's just, yeah, I guess it's all psychology and optics on how they manage that.
And then there's Berkshire Hathaway, right? The original shares are like $400,000 or something because they never did a stock split.
Yeah.
But I think they do have a different type of share, like a different class that has a lower
Class B.
price.
Yeah.
But they just never split. Didn't go and started high and going higher.
Yeah. Yeah.
Okay, so there was a protocol specific question early on, because I think I used Ethereum as an example for some of the stuff that I was explaining in the course. And so of course touched on the Ethereum 2.0 transition, and somebody asked me straight up like, okay, so is Ethereum 2.0 now inflationary or deflationary?
And you said, I've got no idea, but look at ultrasound.money.
I said, depends on how the market works, right?
Yeah. I don't even know.
I mean,
but they've got this chart, and someone tweeted recently that it's not long until they're going to go deflationary.
So for sure, before merge, well, for sure we know Ethereum does not have a cap, right? There's no supply cap like Bitcoin. During the mining process, when it was still proof of work mining, the miners were rewarded with ETH tokens that were minted, I guess coins, theoretically, because they have their own blockchain. They were minted into existence, and that's how the supply was not capped and could theoretically be inflationary forever. But since that's done away now, since post-merge, there's no more proof of work, so miners don't have as high of expenses anymore. So now, from what I understand, they get only paid from transaction fees, and a part of the transaction fees is actually burned during every transaction. So that means miners actually get, I think, only like 70% of transaction fees. Or I guess in this,
how much is burned?
Yeah, like that. And so that means not only I wasn't involved, but they have reduced the kind of emissions of new coins dramatically. And so now, in fact, in burning, but so now it depends on the transaction volume and so forth to see if that'll actually tip it into deflationary territory. And if, I guess if there's low transaction volume, then it won't have a large effect or something like that. That's how I understand it.
Yeah, if the transaction volume is high, then it will get there quicker, right? Because it will be burning more.
Yeah.
More of that ETH will be burning more than, what is created through these staking rewards for the stakers and validators. And I think they've even projected something when that might happen. They have like this supply peak, which they predict around 24th of October. That's yesterday. Shit. So we might already be deflationary as we speak.
Well, it's up 1.5% today, so
yeah.
We'll see how it goes.
I don't know. Maybe I'm just reading this chart wrong, but I think they're projecting it could get into that territory where, kind of like all the supply that is like the lower supply that is coming in through staking has already been burnt through the transactions that are happening. So I think there's something along the lines of we're going to have mildly deflationary, and then it would catch up again and be this mildly inflationary, or at least very low deflation. Yeah.
Yeah, I mean, this is a very interesting site. So anybody that wants to study this in detail, ultrasound.money looks like a fun place to play around and learn. Yeah, what type of price effect do we expect this to have on ETH? We don't give investment advice. However, in my personal opinion, if you reduce supply and demand for ETH remains stable or high, ideally even increases, right, then that would result in a higher price. But as to how high it might go is anybody's guess.
And I mean, you're assuming that demand stays the same, right?
Yes, exactly.
If that doesn't,
at least the same.
down,
ideally over time it goes up, purely because there's so much activity on ETH, like lots of devs building whatever dApps and new NFT projects launching, and everybody that needs to transact in the network needs ETH to pay for gas, right? And that's the ultimate demand driver, I think, for it. So assuming that demand keeps growing and supply gets reduced, then that should drive the price up. But when or how high is anybody's guess.
Let's see.
Yeah, so then protocol specific other questions. So Uniswap is also a well-liked example because, quick backstory, we've talked about this at length, including in an article and community talk and podcasts, maybe has come around already, I'm not sure. Uniswap created a token. They launched without a token, right? Because they don't actually strictly theoretically need it. But of course, we've said before, tokens have lots of benefits to a project, including getting people to stick around, being more loyal, using it as a marketing tool, and many others. And so they launched a token as a response to SushiSwap forking their code and kind of trying to steal all their liquidity away from their liquidity pools. But so when you look at the Uni token, then you see that the Uni treasury only has Uni tokens in it, and there doesn't seem to be any mechanism to ever replenish these. So that basically means the DAO governance who holds these Uni tokens can decide and vote to spend them on stuff like, I don't know, they can pay for developers, or they could pay for marketing, or they could pay for whatever they decide. But then how would the treasury ever be replenished?
Currently it's not. But that's just how they've designed their token, right? They've just built it that way, that there's no new tokens coming into the treasury. And there's speculation on this fee switch. Like we've done, there's an article on it. We've done a tweet thread on it. We can link that. But yeah, that's what they have, right? There's no new tokens coming in. And if they were to implement this fee switch, then they might take a cut off of like currently, if you do a swap on Uniswap, you change USDC for ETH or something like that, you pay a fee, but that fee goes to the liquidity providers, and none of that goes to Uniswap itself, to the DAO. And there's speculations of this fee switch. That means that they would implement something where the fee slightly increases or whatever, and they take some of it, right? They get a part of that fee, and that goes to the treasury. And so the treasury would have an inflow of whatever token. Currently it doesn't. So they're only living off of that Genesis supply and off of the fact that people think their token is worth something. But that's why they can use it for doing stuff, buying stuff or funding developers. Yeah, that's kind of how that works.
Yeah, it's very interesting. I think it's very interesting because I think Uniswap overall is really cool. Like a very, very cool decentralized exchange. Still the dominant one by what do you call that, value locked, or like liquidity they provide.
Total
But
value locked. Yeah.
yeah, but the token is kind of still under development. Like they'll probably keep adding. I assume they'll keep adding features to it and how that whole tokenomics of it works, which I think is actually a great way to do it. Launch and then give yourself the freedom to make improvements later on. Probably the only way to get to something, to a really good system, because I think it's very hard to kind of have all the answers ahead of time anyway.
Yeah.
So we've got two valuation questions. So especially with a really early project, so like there's no revenue yet. That's kind of I think the underlying assumption. What would be a good way to value an early project in the tokenomics space?
I don't know. That's
Yeah, I know it's a tough question.
tough,
I also
right? We've got this evaluation framework, right? And it goes into a few of these questions, right? It definitely needs like a new version, and we've been looking into creating that. But essentially the idea was that when we evaluate tokens, it'd be cool if we had this tool that would help us to take us through a couple of questions and then tell us if it's a good idea to invest in that. And I think that might be something that also helps people to understand, right, to evaluate these early projects. So since it doesn't have any revenue, or maybe doesn't do anything at all yet, you can't really use fundamentals such as a price to sales ratio, because even if it doesn't have any, like, price to sales is meant for early projects. But if they don't have any revenue yet, then that's too early for that even. So you can't really use any metrics other than that. You could maybe use something like the user base. But generally, the evaluation framework, we start with questions around like, how will the project gain value? And that then implies you have to look at how they first create value, right? And then how will that increase over time? Look at the competitive advantage. You can look at the token, like why the token has value. How is that maybe connected to the value gaining of the project? And right, like try and find out about that correlation in general. Yeah, there's a few aspects around Ponzi that we look into in that framework. I'd like that. If it promises any returns, yeah, those are, I think, kind of the things that you can look into early on, like the users, maybe total value lock. There's a bunch of other metrics, and then of course, and I guess we'll get onto that later as well, like the whole vesting and supply. How are they dealing with that? Right? Are there like a ton of tokens coming on the market very quickly? And does that sort of tie with how you think the business is going to grow, right? So if you think the business is going to grow from 1,000 users to 10 million users, yeah, then you can probably then it can probably handle dumping out a lot of tokens. But if it doesn't, then yeah, you might want to look for some slower vesting or unlock of tokens.
Yeah. So exactly what you said. So good rule of thumb. If you're like, okay, token supply is going to increase 10% year on year, then that roughly means the business has to grow 10% to keep up the demand. And that doesn't seem like a crazy number, 10% per year. If the supply increases by 100 or more, then that means whatever the business is doing right now, they have to 10x, right? And that's questionable at best, in my opinion. so then yeah. And then I think a good place to look always is that kind of the gap between total supply, that if there's one set for the token, what's the difference between total supply and circulating supply? And if that is a large gap, then that should give you pause, because then you have to really look, okay, well, how is kind of the remaining tokens that are not in circulating supply yet, how and when will they be introduced to the market? Because those could be really big drawdowns in price otherwise if they come in all at once, or if there's not like a good kind of logic or reason behind introducing them in a way that hopefully in a way that produces supply, but also in a way stimulates demand for it. That would be ideal.
Yeah, like who's going to buy them, right?
Yeah, who's going to buy them? Yeah, and then I mean, so that one question that was here, it's a little formula, a little clumsy. I think you kind of answered it already, but somebody else in the Twitter space also asked me, like, where does the money come from that pushes the token price up? And I'm like, well, that's the question, isn't it? I mean, so just one thing, like the markets
the question.
The markets are very cyclical, right? So we know we have these bull runs. They're usually like a year or something, year and a half, where it seems like it just keeps going higher and higher forever. But then sure enough, there will be a bear market to follow. And then during the bull runs, like the money, I mean, new users entering the space, they're often unexperienced, they don't know what to look at, and they just it's a little bit human psychology. You just see that something's gone up. Say maybe you've watched it for 5 days, right? And you see every day it goes up 10%, then you're like, well, screw it, I'm jumping in, right? It's going to keep going up and I don't want to miss it. And then maybe if you're early, then it might still go up way more, or it might not. It might have been already past the top and it keeps going down. But so the point is, where does the money come from, right? Like the whole point of what we're trying to study in tokenomics now is to find out how to make this stuff sustainable and help projects achieve the goals that they're trying to achieve using the token. And if the goal for them was, hey, I just want to make a quick 10 million and then I want to burn all my investors, like we probably wouldn't help them with that. So we're trying to figure this out for real and help people build businesses that last in this space. Yeah, so reeling that back to the already mentioned vesting and allocation. So got a couple of questions here. So vesting periods, what happens when an unlocking time is near? Is that a buy or a sell signal, right? What do you think, Flo?
Yeah, maybe first, like briefly explain what this is, right? We've got the you've got like your total number of tokens you come up. You can just make up anything. So you have 10 million, and then you can decide whether to, like, then you decide who you allocate these tokens to. You might have to give some to investors to raise some money. You might have some team members that work with you. So you got to give some to them. Maybe there's some other areas like the community might want to give some tokens to. And then, so that's who you're going to give them to. But then there's this time aspect of over what time frame are you going to give that to them? You could give them to them on the very first day. That of course introduces the problem that they could just also sell it on the very first day. And you might not want that, because you might want, you might need some time to build up your project. And so vesting kind of, or unlocking, does that, right? It regulates how quickly your tokens can be sold over time. And yeah, so I guess like when the unlocking time is near, it depends on when these people have bought, right? So let's say and often what we don't see, like what normal retail investors don't see, you'll see a token price of a token for $1 at launch. You think like, oh, that's great, I'm going to buy the token. So you're going to buy the token at $1, and then it might go up to $1.10. But what you typically don't see, or what people should know, is that there's also these like pre-seed and pre-whatever seed round where investors get in prior to the launch. And that also happens with IPOs, right? Like if Warren Buffett buys into some shares, he typically doesn't get into the price that you get in, he gets in lower than that. And before that. So you have to know that when the unlock, or when people are able to sell, when these investors are able to sell, they're in most cases sitting on more gains than you have if you have bought in at that point, right? So they might have gotten the token not for $1, but they might have gotten it for 50 cents. So they already have doubled their money at the day of IPO, and they're like ready to sell. And everything that goes up from there, they're happy to to take these gains. So when that unlock happens, then maybe after a year or so, and the token trades at $1.10, those that would have bought at 50 cents, they still doubled their money, right? And you might only have made 10%, so that 10 cents, right? But yeah, it's kind of that's how to see it. So there's then these tokens coming into the market, but if the token trades at a lower price than what these early investors would have gotten onto, then maybe they won't, right? It all depends. You have to look at where the other people who are in this have what price they have bought in. I think that's the important one.
Yeah.
And typically
Exactly.
you can find that out somewhere, like on CoinGecko or on Misari. There's different sites that have that information on, not always, but in most cases, they'll have that information on what valuations this stuff was traded at and how long the vesting periods are.
In your experience, do they disclose those? Like,
yeah. I mean, they don't have to, but if you just go to CoinGecko, they'll have that in there.
Yeah, there was a good example, right? It was a whole article by Kobe on what is it called, incentive structures or something, and he had a couple of good examples in there. Casta token, also covering that one as a case study in the course. And I think pre-seed investors got in for pennies, right? And then on the launch day, price went up already to $1. So in that case, you might have early investors sitting on 20, 30, 50x profits. And then because like often when I look at these charts, I'm asking myself, like, who's still selling, right? Like the thing went up on day one for like 80 cents and $1.10 maybe and something. So that means most people paid close to $1 for it. And then you see the price just going down and down and down, 50 cents, 40 cents, 30 cents. It's like, so is everybody just selling at a loss? Like, who are these motivated sellers? Well, it's because they, even at 30 cents, they might still be locking in 5x profits, right? So they're like, well, no skin off my nose. I guess this is never going up, so I'll just dump it. And if you're not even aware that this is a possibility, then you can get yourself into a position that the professional term is called being a bag holder. We don't want you to be a bag holder.
Yeah, be careful with that.
Been there myself plenty of times, not in this particular case, but
no, but yeah, if you go to CoinGecko, there's underneath the stats, you can see a tab for tokenomics, and you click on that. Sometimes they'll have that information in there.
When
right, so
we
just
look
click on, maybe not Ethereum, but on something smaller, a project, like Chainlink, perhaps.
Mm-hmm. Did I miss them? Oh, yeah.
Or just anything will do. Yeah, and then you click on the tokenomics tab. And then scroll. They have the allocation, so that like Link was given to public token sale, 35%, node operators got 35, and the company got 30. And then underneath that, you'll see the supply schedule, meaning when these tokens were unlocked. And then also you can see down there, what are the fund rounds for Chainlink? So they raised 29 million on the 19th of September at an average price of 0.09 cents. And so that's, well, you have to know, right? Like these early investors, they got in at these prices. So if Chainlink is trading higher than that, which it probably is, it's trading at almost $7 now. So they're sitting on some nice gains there. But it's also been 5 years, right?
Yeah.
But even if you go back to launch, right? So I assume maybe they launched on November 9th, 2017. They launched at 22 cents. So from that's like more than 2x, right? From 0.09 at launch. So if there was no vesting, these investors, they've just doubled their money. So they might sell half of it and let the remaining part ride risk-free, right?
Well, makes sense.
Yeah. Anyway,
Yeah, cool.
vesting.
Yeah, we'll link that resource. That's a handy one. Okay, so then next question was, how does allocation to the community affect the price? Because the majority of protocols seem to allocate quite a bit to community. Is that good or bad?
Depends.
Yeah, it depends, right? Generally, I think that a reasonable amount of allocation to community is probably a signal that they want to be decentralized in some way. They want their tokens in a lot of hands, and that can be a good thing, right? How do you think?
I mean, but you have to look into it, right? Like, so there's recently this Aptos, I think Aptos is what it's called, this layer 1 blockchain. They launched, and there was a lot of controversy around them not disclosing where their token went through. I think they had a community, they called it a community allocation of a ton of tokens, like a large percentage. And upon digging deeper, you could find out that community meant their own company and some other investor advisor thing, right? So it's just like labeled as community because people think it's, oh, that's great, it's going to the community. But yeah, it's a lot of dodgy shit going on. You can, you really have to look into that. So just because it's called we're allocating tokens to the community doesn't mean anything.
Right. Yeah, it's often a label that's used, right? People are like, oh, that's great, community owned, right? They're like thinking of like the employee owned company or something like that, but it's not, you have to dig deep, you have to understand if that's really what it means or if it's just a label.
And that's where like sometimes you won't even find that stuff in the white paper. And then if that's not the case, then that should be a red flag.
Right.
Like, so we write a lot of these articles, all the Tokenomics 101 articles. That's exactly what we try and find out is like, where do these tokens go to? How are they used? And sometimes it's just not possible to find out.
Yeah, if you have to go all the way to like the Discord and ask them to find something, that's definitely not ideal. Transparency should, like, just like the fact if a project's trying to not be transparent with their numbers should be a red flag, right?
Yeah.
Okay, so then the next one is what happens when a seed investor sells locked tokens to another investor? How would this affect price of the token? So this is kind of like an off-market transaction, right? I mean, I don't think that this happens a whole lot, to be honest. Or maybe it does, but I guess
I think it does. Yeah, why not?
Maybe. But it's kind of this off-market transaction. So one seed investor gets in early. Maybe they want to. The problem is that locked tokens are not liquid, right? They can't sell them on an exchange, so they would have to line up another party to buy them off of them. And so they have to negotiate a price, and then they can do a transaction for this. I mean, they would have to come up with a price between the two of them if there's not a market price yet. Like if the token is like not traded on an exchange at all. If it is traded on an exchange, then there'll probably be a discount because they're locked, or maybe because it's a very large allocation of something. Maybe even there's a premium. Who knows, right? But that will be between those two making a transaction. I don't think this will affect price on the exchange, because effectively from like circulating supply standpoint, nothing happened, and there was no. This was like a kind of you called it black market transaction earlier, but I guess not strictly black market, but it's off market for sure.
Yeah. But then at the time when the unlock happens, right, they might not sit on as many gains anymore, right? So that might affect at the time of unlock who's going to sell. So maybe if there's been a lot of, and I'm not sure if it happens that much, but if there's been a lot of these seed investor to seed investor sale of locked tokens, then they might not sell as many tokens at unlock because they're not sitting on the amount of gains.
Right.
But it's, I mean, it's also, it's up to the negotiation, right? Maybe they might not even be able to sell them at a profit. Maybe the guy who buys them locked might even get them for a cheaper price because the party who's selling them might need money.
Yeah.
And so, yeah, I don't know. There's all sorts of things can happen. I've got no idea.
Yeah, I mean, if it's say investor one gets in early for cheap and then price goes up, I don't know, 10x, right? And then they sell to another seed investor. Then investor one has now realized gains, right? They've made all this money, they're happy. And I think it is a signal of confidence, right? So if another large investor comes in and kind of takes their tokens off of them, then that at least means they're confident that price will have a positive development long term. So I think if you somehow became aware of a transaction like that, I don't think that that's a negative signal. I mean, you do have to look into kind of the details as to what their motivations might be to do that, but yeah, I don't think there will be a direct impact on price. And if anything, it might even be positive long term. Less selling pressure.
Yeah, yeah.
We had one person on the call who asked lots of very specific questions around this topic. And there's still ongoing discussion in the Discord in the tokenomics chat. So if you're interested, please come and check this out. So here it is one version of that. Instead of vesting tokens, why don't projects lock them in an immutable treasury and only pay out staking rewards? So I guess the nuance here would be that I guess the basic assumption is that tokens that vest would be minted, right? So they would increase supply. I think that's the underlying assumption behind this question. And so instead of increasing supply, make all the supply available, lock it, and then just unlock it to pay staking rewards rather than minting them. So it's a nuance, right? And in my first reaction to this question was like, there's no difference. But what do you think, Phil?
Yeah, I'm just thinking like, I mean, even if it was in the treasury, it wouldn't count as circulating supply, right? So it wouldn't impact that much, I think. So I don't think it makes a lot of difference. I think if you have vesting, then it is a bit more rigid of who gets the tokens, because you'll have in the vesting contract, you'll have like a specific wallet that can claim the tokens and no one else can. Whereas if you do staking rewards, those with the highest capital can get access to these tokens. And yeah, the price is dynamic. So there is a reason for why you do vesting, is because you've done some pre or early sales with people to get yourself money for the project, and you don't want them to sell early. So it's I guess just something very different. But impact on the price, yeah.
Yeah.
Tricky. I don't know.
Right. I mean, I think the key piece that you said is if they're in the treasury, they're not considered part of circulating supply, usually, right? Because they underlie some sort of governance that has to make a decision to spend them or sell them, do something with them. So they're not liquid in that sense.
Yeah, I don't think like CoinGecko and sites like that, they count them as circulating supply. So yeah.
All right, so we're getting into mechanisms now. Can you give an example of why buying a token and then burning it is a powerful mechanism? So I think this question was asked based on something that I had said during the presentation, and that was maybe a way for a project to kind of create buying pressure is by using some of their revenue, which is assuming they have some, right? They take some of their revenue and they buy their own token and then they burn it. That might create buying pressure and also would reduce supply. So now, if this were the case, what would you think about this mechanism?
First, like it doesn't sound too bad. But it's this indirect mechanism with which you try to increase your token price. Maybe you will have better avenues to use that token. So there's an article that talks about that, and it basically argues that if you hold, like you buy back these tokens, but you hold them and then you reinvest them into the growth of your business that might be favorable. Stop burning tokens. I think it's that one now. Yeah, so it's kind of like this, put them back into your business instead of just burning them.
How would you put them
But I
back
guess,
into?
well, you could use them for grant programs, let's say,
Hmm.
or you could use them for to fund certain initiatives.
And then
Maybe,
you fund them with token instead, right? So you buy them back
yeah,
and then you give them to people to do stuff with them. Yeah, that makes sense. That should definitely make the pie bigger, right? So rather than reducing supply, which might have a positive impact, but allowing people to build on top of your innovation, that always sounds like a good idea.
yeah. And so the idea is then you have these tokens, you give them out to people who build stuff, and those people who build stuff, they might see themselves then as owners of the project. So they might not sell all of these tokens, but they might hold on to some because they feel themselves as owners because they built a part of the project. So it's this, yeah, like you said, making the pie bigger. That's kind of the argument of that. But yeah, I mean, burning can also work. I don't see a reason why not. It's just like if you, I think like if you have this programmed in to some smart contract that says like, oh, every month we're going to go and buy tokens. Yeah, you might not always get the most favorable conditions for buying and burning.
Right, that's for sure.
But yeah, I mean, you could also argue that dollar cost averaging is a better strategy than trying to time the market. But I don't know. Yeah.
I mean, if it was very substantial buys and you would always do them on the same day, people would start front running them. But if you kind of
Yeah.
keep it in the dark, maybe you have some more some logic behind it when you buy, like only certain market conditions or something, then
Yeah.
I think generally if you have excess revenue, buying back your token is probably that in general. I don't really see why that would be a bad idea, but as to how you do it and what you do with the token, I guess that's the question.
Yeah. Depends on a lot of things, I think. Yeah.
But it's over, yeah, exactly. But in general, I mean, if a project has enough revenue from their value creation to even buy tokens, that's already great.
Yeah, you might want to diversify, right? You might not want, because you already have so many of your own tokens, you might want to hold other assets, and you might be happy to keep that USDC revenue that you have.
Yeah, true. Maintain some liquidity throughout the bear market, for example.
Yeah.
Okay, so because regulatory clarity of token burning is missing, do you feel like there could be another solution that you could, so where you could send tokens until you get a green light from regulators? So this question caught me a little off guard because I was not aware that there is regulatory uncertainty around token burning. Have you heard this?
I'm not an expert.
Yeah.
I've got no idea. I haven't heard this. I heard like, dividends, you're not allowed to pay out
Yeah.
dividends, but I don't know about burning, what that does. Yeah. I've got no idea.
So the asker had suggested, well, instead we could just put them in a vault and wait, but it would still remove them from circulating supply. And I'm like, well, I mean, a burn is just sending them to a zero wallet where, I mean, they cannot be recovered, which I guess would be the difference. But I mean, doesn't seem that big of a difference. I assume it'd just be if people, like if project decided to just send their tokens into a vault that they do have the key to, then I'm like, rather, I mean, then go back to previous question. Well, then rather just set up a grant and fund stuff with it, right? Like that seems to make a lot more sense than to just hold them.
Yeah. Yeah, exactly. Totally. 100%. Yeah. And I don't know I've got no idea. Like what counts as a circulating supply?
Yeah.
Right? Like does it count if they're in a smart contract and they can only get out if there's more than 4 people required to get them out? Or like what is it that makes something not circulating?
It goes to the whole question of, are staked tokens part of circulating supply? And I think projects want to say no, they're not, but then in effect, so there was also some discussion on Discord about that.
Yeah.
Where Sextus had said, well, he did a study on it. Unfortunately, we don't have a link to it. And he said there was very little effect on price, because usually the people that stake the tokens can also unstake them just as
It's very
easily.
liquid. Yeah.
Yeah. So it's exactly, and then even if it's not, then there's often then kind of add-on projects come into existence where they're like, oh, you have your tokens locked for a year. Well, here's our liquid staking kind of derivative that makes it tradable again and stuff.
Yeah.
So it's like it seems to not really be that locked.
Yeah.
So that kind of
True.
puts a whole question mark behind the stake rewards in the first place. But this always brings me back to, where does the staking come from originally? And it's from proof of stake blockchains, where the mechanism is to put capital at risk, and you promise to say, hey, I put this capital at risk and I promise to validate transactions truthfully. But if you don't, then this capital can also get slashed, right? And so that is why, because you're providing a service to the network, this validation of transactions is kind of the product of that blockchain, right? And you're helping create that, and so you get paid to do that. That's the staking reward. But then so many projects have just started, just lock them and we'll give you more token, and that's kind of silly, right? It doesn't actually provide any value. It's just a loose promise to say, oh, I won't sell today, but it's not really.
And you got to be careful, right? Not calling it locking, because you're not locking. You're just like, you're placing a hold that you can revoke at any time. I mean, there's different ways. There's some staking contracts that you'll have like a 20-day wait period or something. Then they're locked for some time at least. But if you're just this plain staking and you can withdraw at any time, like, what does it do, right? If you want to sell your tokens, you can go and sell them. Just withdraw them from it and then sell them. Anyway,
Even if it's a couple of weeks lock, I mean, I don't think it makes that big of an impact. Short of. So there's a question around governance. So how does staking for governance rights work, and who benefits?
I think it's the same. Like, staking for governance rights doesn't make any sense to me. Like, you might as well just let holders of tokens vote. But then there's this whole VE thing where you lock tokens for a longer amount of time, and that might give some more commitment to these token holders, right? Because if they're willing to lock up their token for a certain amount of time, then they might be more committed to the project, and thus make better governance decisions.
I mean, that's the theory, right?
That's a theory. I can't, who can prove that?
With balancer VE tokens, there's a requirement to also put in ETH with it, right?
Wrapped ETH. You have to, you have to pool the balancer token and wrapped ETH to get this other token, and then you can lock up that other token to receive the VE token that allows you to vote.
And so here, I mean, I don't really know if that's just extra steps or if that's meaningful, but it feels more meaningful to me, because I'm like, if I lock my ETH, then I'm definitely foregoing opportunity cost or something like. I mean, I might incur some opportunity cost. So that might in fact make me more committed to the project, but I'm not really sure if it's not really the same. If it's still not mostly the same as staking for governance. But I mean, in general, the idea that you have to be kind of a substantial token holder or staker in this case to get, for example, to be allowed, for example, to make a proposal in governance, that does seem to make sense, because you're filtering for people that have accumulated a large amount of your token. And so you don't want somebody who has like 1 token or 0.1 token to come in and make a proposal, because even just reading and working through those proposals can be time consuming.
Yeah.
So that makes sense in a way, but then at the same time, you're also making the influence is kind of put up for sale in a way. So I don't really know. I don't have like a definitive opinion on this yet. But I kind of have to admit, I've also have to yet to see governance to really make like a real positive difference, I guess. I mean, and I'm sure that's just my own ignorance. I'm sure there's project where it works great, but
Yeah, I don't know.
I mean, I've seen many like governance polls where it's like there's only 10% or whatever is even coming in for a vote. And I'm like, well, that doesn't really seem like a very engaged community. But
Sounds like the standard democracy. Not even worse, right?
yeah. Okay, so moving on. How can we predict that burning a certain amount of tokens at a certain market cap will result in a certain effect on price? This was like, okay, so for example, this was also, there's still, I think, also discussion in the tokenomics chat on Discord about this. There's like different ideas behind that. But so generally speaking, I don't believe that that it's that simple. So you, by saying, okay, I'm going to burn 5% of my supply, that means price should go up 5%. Like it's not that the correlation is not that simple. It always depends on the underlying supply and demand characteristics. So previously mentioned briefly that Casta token, like this influencer token that had really cheap pre-sales and then went like to $1 on launch day. Well, in the analysis that Kobe did in his article, he uncovered that only, I think, 2.5% of total supply were even up for sale on launch day. So that means only just repeating that, only 2.5% of supply were even on the exchanges to be traded that day. So it was an extreme supply shortage, which made it even possible that price could go up that high. But so that means if in that context, if that day you would have increased supply by 8%, that would have made a massive difference, right? So that would have made price maybe 30% lower or something. So like very small tweaks to supply can make a massive difference, but it always depends on the context. So I don't think that there's no simple correlation, unfortunately.
Yeah, I don't
What do
think
you
there's
think?
any.
Yeah.
No, I think like generally you can assume that if everything stays the same and you take them out of circulation, that would be favorably, but like who knows if everything stays the same? Hardly ever does, right? There's anything that can happen, and I don't think you could predict this.
Yeah. Okay, next one, second to last question. So what is the alternative way for the protocol to provide rewards after tokens are all vested? So what is it? Yeah, so how can protocols provide reward without tokens, basically?
Well, you could alternatively, you could just provide a great product
yeah, provide a product
and make your customers pay for the great product instead of paying them to use your product.
Right.
I think this is really, really important, that, and like a lot of projects get wrong or fail at is tokens are great for this cold start problem, right? You want to start this marketplace and you want to get people going and using it because you need buyers and sellers on your marketplace to both come. And so a token can be good to do that. So you'll take a time frame of 6 months, a year, and you're going to give out token to these people to come use your marketplace. But then at some point you have to stop, because otherwise they're only there on their platform because you pay them for it. But that's, of course, that can't be your business model. Your business model should be that you're adding some benefit of them trading. You're giving them this platform and they like that because on this platform, they can reach so many buyers and sellers, each other, that they'll stay not for the token rewards, but they'll stay because it's a great platform to use, right? And so then, yeah, you might not need any more of that. But if you do, and you might want to, let's say you've launched your platform, it all went great, and now you want this second thing that you want to launch, you want to get people to use that. From that, you could perhaps, from that revenue you've made, you could buy back tokens, or you could use these bought back tokens to then reinvest them into these incentive programs in new things. But I think it's really, really important that people get off of this yeah, get off of this cold start problem. Like once you've started, like stop at some point and make sure that your business also works.
Yeah, 100%. In addition, I mean, I think your answer was way better than the one I gave, but mine was, I think, well, pulling up Uniswap example again, right? So Uniswap worked great, and the reward was just trading fees to liquidity providers. They didn't need any token. They just paid them out of the tokens that were traded. I mean, the fees that people paid to trade. So it was ETH, right? So they just used ETH because that's what everybody wants anyway. Rather than convincing them that your token is somehow also good, you can just pay rewards in something else. I mean, here in tokenomics DAO, we have revenue in USDC or some other stable dollar stable coins, and so we pay out rewards with that. Nobody's turned it down yet, so it works great.
I'll take it.
Yeah. So final question, and this one was this is like one of those, if we knew the answer, then we'd already be rich. How do you create a token? So it's asked a little clumsily, but I'll explain. So how do you create a token with a mix of projects so that you can be insulated from an event such as the blow up of Terra Luna? So it means kind of, first of all, I guess, how can you uncover instability in an ecosystem? Is there like things to look out for? And the other thing is, could Terra Luna have diversified to such a point where basically the blow up would have not happened? What do you think?
Wow. I mean, they tried
Yeah.
buying Bitcoin, but ultimately the doom loop was too strong. And since it was not backed enough, people didn't believe in it, right? So it's a belief system, and the belief system failed. And if you don't have anything or guns to back up your belief system, then yeah, people stop believing in it. And if they don't believe in it being able to hold par with the dollar, then they're going to sell it, right? Because that's what I would do. And so you start doing that, and then we've got the same supply demand thing that we talked about the whole podcast now is like, if there's nobody willing to buy it, then yeah, you got to sell it for cheaper to attract these remaining buyers that are going to go for it. But I think generally diversification is always good, is always important. You don't want to have all your eggs in one basket, as they say.
Yeah.
And I don't know if that's the idea of the question, right? But like, I think it's always good to have, if you're investing generally, to have a bunch of different assets if you want to play it safe. If you're more like, I want to get rich quick, it might be good to gamble all your money on some interesting project that you think can 10x, 100x, whatever. But if you're more playing it safe, probably good to diversify.
Yeah. And I mean, there was people describing the doom loop, right, ahead of the blow up on Twitter with a lot of detail. And it was Do Kwon was like famously making fun of it, saying you're crazy. But hindsight is always 2020, so I don't really know. I think a lot of the signs were there, but it's just hard to also make yourself listen when the Luna token had gone up so much, like a couple of 1,000% over a short amount of time. But then I guess something that I had experienced for the first time was really this like ecosystem risk, I guess, where obviously the stablecoin melted down, but what I didn't quite realize is that even if you had ETH or other assets like AVAX or whatever on that chain, it also was worth less all of a sudden, right? And I was like, well, now thinking about it, it's like, well, it's obvious, right? Because it's just it's basically exchanged. You're transferring it into that value system, and if the whole thing goes down, then your assets go with it, even if it's some form of wrapped ETH or something like that. But this goes back to knowing what you're getting yourself into ahead of time and trying to understand these systems. And if you don't understand them, then better not invest, right? Unless it's money you have to lose, and you're playing, right? You're playing, and I think playing around can also be a really great learning tool. So like
but don't bet the farm on playing around, right?
Yeah, exactly. But don't bet the farm. Don't bet anything you can afford to lose. I do think taking like a small investment in a project is a good way to also make you care enough to then go and do the research. So it might motivate you, but then definitely it's a small amount, right? Yeah.
I guess like one more thing on that is, I think what people always do wrong is when they're invested in some project, all they do is like they go into this echo chamber and try to look for confirmation, right? Nobody wants to go and hear somebody bashing the thing that you've just bet the farm on, right? That you don't want to hear that. So you try to avoid it, but that is what you should be hearing, or what you should be listening to. The people who say like, no, man, this is not going to fly for these obvious reasons. So that's what you should look into and dig into, right? Not the ones that say like, oh, this project is going to do 100x, it's going to be worth 20 billion by then and going to do that, right? That's like useless because you're invested anyway. So who cares? You want to hear what could go wrong, or why it wouldn't work, or why it only increases by 1% in the next 10 years.
Yeah, definitely. That definitely resonates with me, because I lost a lot of money in that blow up, and I guess I knew better, and I still didn't listen, right?
It's hard.
But nothing, luckily nothing I can recover from, but definitely still sucks. But
yeah, true.
Yeah, I thought this was cool to go through these questions. Thank you, Flo, for giving a lot of background on that, and I think we got some good resources to link to as well, which I'll also probably integrate into the course, because I think having these is also it's all about like helping people to kind of do the research themselves, and finding the resources, using the resources. And we'll of course also link to the course in case you're interested. Should be fully available, all 5 chapters, here by the end of October. So basically this week, end of this week. And this will probably not the last time we're going to come and talk about basics of tokenomics, because I think there's always interesting questions to discuss. And
if you have anything, send it through, right? We're happy to talk about topics that you guys are interested in. Let us know.
Yeah.
Discord, Twitter, wherever. Email, write us a letter. Anything,
exactly. All the channels are open. Cool. All right.
This podcast was not financial or tax advice. This channel is strictly educational and is not investment advice or a solicitation to buy or sell any assets or to make any financial decisions. This video is not tax advice. Talk to your accountant, do your own research. None of this is legal advice. This podcast is strictly educational. Talk to your lawyer.